In the grand scheme of corporate finance, the sources of long-term finance are as diverse as they are crucial. Let's dissect this intricate web, starting with equity capital. This can be public equity, where shares are issued to the public through an initial public offering on a stock exchange. Alternatively, it can be private equity, where investment is garnered from private equity firms or venture capitalists in exchange for equity ownership. The next piece of the puzzle is debt capital. This can come in the form of bonds, where corporate bonds are issued in the capital markets with fixed interest payments. Companies can also acquire long-term loans from financial institutions, often secured by assets or unsecured based on the company's creditworthiness. Then there are debentures, which are long-term debt instruments issued by companies with a promise to repay the principal along with interest. Diving deeper, we find retained earnings. This is the accumulation of profits generated from previous years, retained for reinvestment in the company's operations or expansion. Next up are preference shares issued to investors, carrying a fixed dividend rate and a claim on assets before common shareholders in case of liquidation. Venture capital is another key source, attracting investment from venture capitalists, particularly for startups or high-growth companies, in exchange for equity. Angel investors, individual investors who provide capital, often in the early stages of a company, in exchange for equity ownership, also play a significant role. Government grants and subsidies, financial support from government programs designed to encourage specific industries or activities, cannot be overlooked. Neither can leasing, where companies enter into long-term lease agreements for assets such as machinery, vehicles, or real estate. Convertible debentures, debt instruments that can be converted into equity at a later date, offer flexibility for both the company and investors. Project finance secures financing for a specific project based on its anticipated cash flow and assets, often used in infrastructure or large-scale projects. Internal accruals, funds generated from the company's operational activities and reinvested for expansion and royalty financing, funds obtained in exchange for a percentage of future revenues, commonly used in industries like mining or entertainment, are also viable options. Sale and leaseback, selling assets such as property or equipment and then leasing them back from the new owner, frees up capital. Strategic alliances and joint ventures, partnerships with other companies to share costs and risks, and insurance financing, using insurance policies as collateral to secure loans, all add to the diverse tapestry of long-term finance. In summary, companies have a rich array of sources for their long-term finance. From equity and debt capital to retained earnings and preference shares, from venture capital and angel investors to government grants and subsidies, leasing and convertible debentures, project finance, internal accruals, royalty financing, sale and leaseback, strategic alliances, joint ventures, and insurance financing. The financial world is a vast ocean of opportunities. Each source has its unique advantages, risks, and considerations, but all play their part in the grand puzzle of corporate finance.